Hello students, welcome to the lecture on money and banking, and after this lecture we will be able to learn the following objectives. Understand the concept of barter system and evolution of money, study about inflation and its types, understand the concept of money supply and money creation. Let us begin by studying a very brief history of the development of money and banking. Trade began with a whole barter, trading one item from another. This is the simplest form of trading. However, it is cumbersome and often will not work. It requires two people who each want what the other has. If one party wants something else, whole barter breaks down. Limitation of barter system lead to the evolution of other forms of currencies. So early on, people invented or discovered mediums of exchange or currency of some kind, beads, seashells, salt, precious metals, gems, gold coins, tobacco leaves, hemp, and many other items have been used as currency. Now you must be thinking that how currency is useful in trading. Instead of trading directly for what one wants, one of the parties accepts currency for the transaction and then trades the currency with someone else to obtain what they want. The main requirements for money or currency are that it be readily identified and valued, that it has some more or less stable value, and that the parties agree to use it as currency. Now we will move further and study about the evolution of paper money. As civilization progressed and trade increased, more and more medium of exchange was needed. Gold and silver coins were popular but somewhat inconvenient to carry around. Goldsmiths began to offer to store people's gold safely if one did not want to keep it in one's house. This was the beginning of modern banking. The goldsmith issued paper receipts when they accepted gold from storage. Soon people began trading the paper receipt. This was much easier to carry in one's pocket. As long as a person knew the goldsmith, they would accept the paper receipt as being equal in value to the gold itself. This was the beginning of paper money, which soon became the dominant trading medium. The corruption of redeemable paper money and the development of fiat money. The original paper received that early bankers gave to those who deposited their gold or silver had no intrinsic value. Their value was due to their being redeemable in real or tangible money. But with time, the system changed and led to the birth of fiat money. Fiat money is paper money is not redeemable for anything. Fiat money would never arise spontaneously because no one would accept it. Why would anyone accept a piece of paper as payment unless one believes it is backed by something of real value? Fiat money rises for two reasons. Legal tender flaws. These are laws that force people to accept only one kind of paper money. Federal Reserve notes in America, for example, are forced by law on the people of America even though they are not backed by anything other than the faith in the banking system. Cheating. Fiat money can't arise if someone, either an individual or a bank, issues receipts that claim to be redeemable but in practice are not. In this case, the people believe their paper money is backed by gold or silver, but in reality it is not. This is really the crime of counterfeiting. In most nations today, both the above are used to make sure the people only have fiat money. Now we will move further and study about inflation. Inflation is defined as a sustained increase in the general level of prices for goods and services. It is measured as an annual percentage increase. As inflation arises, every dollar owned buys a smaller percentage of a good or service. To study inflation, one should be clear about the inflation rates. In economics, the inflation rate is a measure of inflation or the rate of increase of a price index such as the consumer price index. It is the percentage rate of change in price level over time, usually 1 year. The inflation rate is used to calculate the real interest rate as well as real increases in wages. There are therefore many measures of inflation depending on the specific circumstances. The most well known are the CPI, which measures consumer prices, and the GDP deflator, which measure inflation in the whole of the domestic economy. Types of inflation. There are various types of inflation. Let us discuss some of them. Creeping inflation. When prices are gently rising, it is referred as creeping inflation. It is the mildest form of inflation and also known as a mild inflation or low inflation. According to R.P. Kent, when prices rise but not more than up to 3% per annum, it is called creeping inflation. Galloping inflation. According to Professor Samuelson, if prices rise by double or triple digit inflation rates like 30% or 400% or 999% per annum, then the situation can be termed as galloping inflation. When prices rise by more than 20% but less than 1000% per annum, that is between 20% to 1000% per annum, galloping inflation occurs. Hyperinflation. Hyperinflation refers to a situation where the prices rise at an alarming high rate. The prices rise so fast that it becomes very difficult to measure its magnitude. However, in quantitative terms, when prices rise above 1000% per annum, it is termed as hyperinflation. During a worst-case scenario of hyperinflation, value of national currency of an affected country reduces almost to zero. Paper money becomes worthless and people start trading either in gold and silver or sometimes even use the old barter system of commerce. Demand pull inflation. Inflation which arises due to various factors like rising income, exploding population, etc. leads to aggregate demand and exceed aggregate supply and tends to raise prices of goods and services. This is known as demand pull or excess demand inflation. Cost push inflation. When prices rise due to growing costs of production of goods and services, it is known as cost push supply and side inflation. I hope you understood this concept that I just explained. Now we will move further and study about how to measure inflation. The formula for calculating the inflation rise using the Consumer Price Index is relatively simple. Every month, the Bureau of Labor Statistics (BLS) surveys prices and generates the current Consumer Price Index (CPI). Let us assume, for the sake of simplicity, that the index consists of one item and that one item consists INR 1 in 1984. The BLS published the index in 1984 at 100. If today that same item costs INR 1.85, the index would stand at 185. By looking at the above example, common sense would tell us that the index increased. It went from 100 to 185. The question is, how much has it increased? To calculate the change, we would take the second number 185 and subtract the first number 100. The result would be 85. So we know that since 1984, prices inflated by 85 points. Since we know the increase in the Consumer Price Index, we still need to compare it to something. So we compare it to the price. It started at 100. We do that by dividing the increase by the first price, or 85 by 100. The result is 0.85. We multiply by 100, and so the result is an 85% increase in prices since 1984. What happens if prices go down? If prices go down and we experience price deflation, then A would be larger than B and we would end up with a negative number. So if last year the Consumer Price Index CPI was 189 and this year the CPI is 185, then the formula would look like this. This equals negative 2.11% inflation over the sample year. Of course, negative inflation is deflation. In this section, we will study about money. How is it measured? Money is the $10 bill we lent to our friend the other day and do not expect back anytime soon. But exactly how much money is out there and what forms does it take? Economists and investors ask this question every day to see whether there is inflation or deflation. To make money more discernible for measurement purposes, they have separated it into three categories. M1. This category of money includes all physical denomination of coins and currency demand deposits, which are checking accounts and now accounts and travelers' checks. This category of money is the narrowest of the three and can be better visualized as the money used to make payments. M2. With broader criteria, this category adds all the money found in M1 to all time related deposit, saving deposit and non-institutional money market funds. This category represents money that can be readily transferred into cash. M3. The broadest class of money, M3, combines all money found in the M2 definition and adds to it all large times deposit, institutional money, market funds, short-term repurchase agreements along with other large liquid assets. By adding these three categories together, we arrive at a country's money supply or total amount of money within an economy. How money is created. Now that we have discussed why and how money, a representation of perceived value, is created in the economy, we need to touch on how the central bank can manipulate the money supply. Among other things, a central bank has the ability to influence the level of a country's money supply. If it wants to increase the amount of money in circulation, the central bank can, of course, simply print it. Another way for the central bank to increase the money supply is to buy government fixed income securities in the market. When the central bank buys these government securities, it puts money in the hands of the public. To shrink the money supply, the central bank does not opposite and sells government securities. The money with which the buyer pays the central bank is essentially taken out of circulation. After studying about money, it will be easy for you to understand the concept of supply of money. There are several definitions of the supply of money which we have studied earlier as M1, M2 and M3. Now let's move further to understand banking business. In order to understand the factors that determine the supply of money, one must first understand the role of the banking sector in the money creation process. Banks perform two crucial functions. First, they receive funds from depositors and in return provide these depositors with a checkable source of funds or with interest payments. Second, they use the funds that they receive from depositors to make loans to borrowers, that is, they serve as intermediaries in the borrowing and lending process. The deposit that banks keep on hand are known as the bank's reserves. When depositors withdraw deposit, they are paid out of the bank reserve. The reserve requirement is a fraction of deposits set aside for withdrawal purposes. The required reserve ratio is decided by country's central bank. Deposit that banks are not required setting aside as reserve can be lent to borrowers in the form of loans. Bank earn profits by borrowing funds from depositors at zero or low rates of interest and using these funds to make loans at higher rates of interest. How banks create money. Consider what happened when the same bank received a $1 lakh deposit from one of its depositors. The bank is required to set aside 10% of this deposit or $10,000 as reserve. If then lends out its excess reserve, in this case the remaining $90,000 of the initial deposit. Suppose for the sake of simplicity that all borrowers redeposit their loans into the same bank. The bank does receive $90,000 in new deposit, of which it sets $9,000 aside as reserves and lends out all of its excess reserves. Suppose again that all borrowers redeposit their loans in the same bank, that the bank sets aside a portion of these deposits and that the bank then lends out the remainder, which is again redeposit in the bank, and so on and so on. Money multiplier. The amount by which bank deposit expand in response to an increase in excess reserve is found through the use of the money multiplier, which is given by the formula money multiplier is equal to reserve requirement. In the example of deposit expansion, the reserve requirement is 10%, so the money multiplier in this case is 1 by 0.10 is equal to 10. The excess reserve resulting from the initial deposit of $1 lakh are $90,000. Multiplying $90,000 by the money multiplier 10 yields $9 lakhs, which is the amount of additional deposit created by the banking system as a result of the initial $1 lakh deposit. Central banking and the supply of money. A portion of each nation's money supply, M1, is controlled by a government agency known as a central bank. The central bank is unique in that it is the only bank that can issue currency and has control over the supply of the currency. The central bank also has control over the private bank reserves that banks entrust to the central bank. Banks hold a portion of their required reserve with the central bank because it acts as a clearinghouse for all sorts of transactions between banks. For example, the processing of all checks. The central bank's liabilities therefore consist of all reserve notes in circulation plus all private bank deposit held as reserves on the asset side. The Fed can also control the supply of money by its choice of the reserve requirement. If the central bank increases the reserve requirement, the money multiplier decreases, implying that deposit creation and the money supply are reduced.
Okay. So, as an investment banker with ABC Wealth Management, you must be very familiar with the nature of financial markets.
Yes, very much so.
How do you think things are going at the moment?
Well, there's a great deal of international concern, but things will sort themselves out. This is what markets do, through a process we call volatility.
Can you explain to me how the banking industry works?
Sure. Assume I'm a bank. I make money by lending it out.
Yes. People deposit their money with you at a lower interest rate than what you lend it back out again at.
Well, yes. But that by itself isn't really all that profitable.
What do you mean?
It is true that I lend out money collected from the depositors, but it's more than that. I lend out many times more money than is what actually in the bank vault.
How can you do that? Is that not fraud?
No. That's called fractional reserve banking, and it's perfectly legal.
But Mr. Lloyd, how do you lend out more money than you have?
By creating it. Let's assume that you are asking for a loan to purchase a house. When you sign the mortgage agreement, that money is created right there and then, and is backed by your obligation for repayment. And if I'm successful, you will also pay the insurance costs in case of a default.
So, Mr. Lloyd, what you are telling me is that the money I get from you doesn't exist until I sign the mortgage agreement.
Exactly. Wonderful, isn't it? See, this is what grows an economy. And as you repay your mortgage, I can use that money to lend out even greater amounts.
And who do you lend this additional money to?
People who need credit, of course. You see, as I just explained, money creates more money. So we grow and broaden the economy, expanding it all the time. We need to lend so people can continue to buy.
But shouldn't people just buy the things they can afford?
No, Julia. You don't need to afford the things you buy. You only need to afford the interest on the money you borrow in order to buy the things.
Do people really need to be buying all these things?
Well, they certainly believe they do. And who are we to suggest they don't? People regard these things as being very necessary, deeply important, and extremely attractive. You see, it is really all about building a stronger economy. We truly have your best interests at heart. Without an economy, you wouldn't have a job and could not afford the things you need.
I hope you understand this concept that I just explained. Now we will move further and study money creation. Before analyzing the process of money creation, we must first review the nature of money and the reason why it exists. Money exists in order to facilitate the making of transaction. It saves the labor and capital resources that would have to be used if barter were the only method of exchange. Money consists of cash in pocket, bank deposit that can be transferred by check, and depending on how broadly we define it, are the bank deposit and highly liquid assets that can be quickly converted into cash at prices known in advance. In the discussion that follows, money will be defined simply as cash in hand plus bank deposit. In modern economies, the money supply is determined by the government. The government puts money in circulation every time it buys goods or assets from the private sector and takes it out of circulation by levying taxes on the private sector and selling assets to private institutions and individuals. When the government exchanges money for goods or securities, the stock of money in private hands necessarily goes up, and when it sells assets to the private sector or levies taxes, the money it receives goes out of circulation. We must distinguish here between two branches of government, the Treasury and the Central Bank. The job of the Treasury is to budget the government's expenditures and finance them either by levying taxes or borrowing. Since every dollar it spends must be raised through taxes or borrowing, the Treasury's action do not change the money supply. It is the central bank's job to manage the money supply. It puts money in circulation by purchasing bonds from the private sector and takes it out by circulation by selling bonds to the private sector. These actions are called open market operation. The central bank also manages the government's deposit accounts on which checks are written to pay the government's expenditure. These deposits typically are in part with the commercial banks and in part with the central bank itself. The Treasury normally issues bonds to finance some portions of the government's expenditures. Central bank then buys in the open market an amount of these sufficient to put in circulation the appropriations quantity of money. Now in the end, let us summarize what we have learned in this lecture. Trade began with whole barter, trading one item from another. This is the simplest form of trading. Inflation is defined as a sustained increase in the general level of prices for goods and services. It is measured as an annual percentage increase. As inflation rises, every dollar owned buys a smaller percentage of a good or service. Banking business receive funds from depositors and in return provides these depositors with a checkable source of funds or with interest payments. They use the funds that they receive from depositors to make loans to borrowers, that is, they serve as intermediaries in the borrowing and lending process. M1 is narrowest and most commonly used. It includes all currency notes and coins in circulation, all checkable depositions held at banks, bank money, and all travelers' checks. A somewhat borrower measure of the supply of money is M2, which includes all of M1 plus savings and time deposit held at banks. The amount by which bank deposit expand in response to an increase in excess reserves is found through the use of the money multiplier, which is given by the formula money multiplier reserve requirements.